Hello, everyone, and welcome back to another Compliance Corner. This month in December, we have a few different items for you. So why don't we get started with the list of what we have? And it's enough that we actually have 2 slides of summary for you. But the first thing you're going to notice is at the top, front, and center, we've got Section 1071. As prophesized, we have a new proposed rule, so we'll cover that for you first in just a moment. But some other items we have are some recent IRS issuances, which I know are going to be of interest to many of you. We have the ACRE Act to discuss, as well as a new car loan interest reporting, including some additional forms. We also have some various agency releases to cover. We've got some FRB releases, including Enhancements to Bank Supervision, the 3rd edition of the 2025 Consumer Compliance Outlook, and the December 2025 Supervision and Regulation Report. For OCC, we have some updates to the SCRA booklet of their Comptroller's Handbook, Community Bank Minimum BSA AML examination procedures, and discontinuation of the annual AML risk system collection, as well as 2026 assessment rates. Then we've got FDIC and some interagency announcements, as well as a quick reminder. But on the topic of FDIC, we'll talk about a final rule to postpone compliance dates for Part 328, which is another issue we've been talking about in past compliance corners, and a final rule to adjust certain regulatory thresholds to allow for indexing, which I know many of you are looking at as well. For interagency items, we have a request for information on updates to call reports and a proposal to revise the community bank leverage ratio framework. Then lastly, we wanted to give you a reminder quick on the SBA debanking letter and when reports are due on that. So with that, let's get started. And as promised, we have our 1071 saga continuing and perhaps reaching a bit of a climax, so to speak, as we refer to it indeed as a saga. But we do have a proposal from CFPB. And many of you, if not all, have likely seen that there are several significant changes here, but we wanted to summarize them. We wanted to highlight them for you, as this is something that's been the subject of numerous proposals, numerous conversations from CFPB, numerous comment letters and advocacy on behalf of the industry. So let's take a moment to go through the proposal and what it means and what CFPB has done here. So first, the rule would exclude farm credit system lenders and agricultural loans from coverage. The rule would also, kind of along those lines of coverage and what is going to be within the scope of the rule, making some adjustments to the origination threshold. In fact, it was raised substantially. So if you think to the 2023 rule, where we had 100, we're now going to 1,000 covered credit transactions over 2 consecutive years. So this change also applies to bona fide error provisions, if you recall that section within the rule as well. Then we also have a change to another item that was a topic of discussion and somewhat confusion as to what this definition actually is, that being small business. So long story short, that old definition, kind of remember the roundabout way we got there from the SBA definition, has now been tightened up a bit. So the gross annual revenue threshold is still there, but we're kind of clarifying and again tightening and focusing on that definition, and then more specifically and explicitly dropping it from $5 million to $1 million or less. Then perhaps one of the most requested changes, one of the most requested topics of focus for CFPB and ongoing conversation has been specific to the data collection itself, but the discretionary data points. And so the proposal does remove several discretionary data points. So think on some of those that were including application method, recipient denial reasons, pricing information. A lot of those discretionary data points that weren't in the original 1071 rule have been removed. Finally, CFPB has proposed a compliance date of January 1st of 2028. Just as a reminder, this is a proposal, of course. And in that being a proposal, WBA will be commenting on it, and comments are due on December 15th. So that is coming up very soon after this video drops and you are viewing that. So if you're viewing that and taking a look at your calendar and thinking you've got some thoughts on this, or you're reading it through and have something that you want to share, make sure to reach out. Any comments or any feedback that you have, we want to hear from you. So give us a call, give us an email. We'd be happy to talk to you about this proposal, share with you what we're working on, and wrap anything specific that you'd like to include in the letter to CFPB. So with that, looking forward to sending those comments off after this long-awaited proposal. Again, as we had anticipated, here it is. So again, if you want to see it in full, click on the link in the description below. You'll see the rule and the proposal. It is actually, some of it is a fun read. So even if you want to take a look, at the rule itself toward the end, but take a look at some of the preamble as well. There's a lot of background here, right? And so CFPB is, of course, acknowledging all of that as well. But with that, I will hand it off to Heather to continue on with our next items.
Super. Thank you, Scott. It's always good to see the CFPB issuing something new here that's gone in the right direction for the membership. So thanks for taking the lead on that particular comment letter. Next up is IRS guidance. We have two different topics that we want to cover from the IRS. Now, certainly Scott and I are not accountants, but we want to make sure that you are aware of guidance being issued on the topic of both the ACRE, or what we're referring to as the ACRE Act, and on the car loan interest that we're receiving. So we're referring to this as the ACRE Act. It's not technically the ACRE Act, but we've come to call that, use that term here in this second session that this issue has been worked through on the federal level. So the actual title is Interim Guidance regarding interest on loans secured by real or agricultural real property under the Internal Revenue Code. Otherwise, we're calling it ACRE Act, as you can see why. But what this is a new provision from the One Big Beautiful Bill Act, which Section 139L was created, which is allowing for lenders to exclude 25% of interest income earned on loans that are secured by rural and ag real property. And so what this guidance does is it tries to put some guardrails around what we mean by these different terms. It goes through and identifies who, that being all of our member banks. It looks at what qualifies as a qualified real estate loan. This is typically going to be something, again, that is a real estate secured loan that is ag purpose, or being used for some type of crop production, as that's further defined within this guidance. It has to be made after a certain period of time, that being July 4 of 2025, which was the enactment date of the act itself. And we have to look at really what is considered rural and ag real property, as the IRS is looking to define that. We have to look to what is the value of the property? What is the value of the collateral? Because it's that dollar amount that is helping us identify how much is the loan for which the interest can be deducted from income that's been earned by the bank. Find within this actual guidance itself, again, it's proposed guidance. There are good faith standards. There are some refinancing rules that are within this initial guidance. There's also a safe harbor for helping to calculate what is that value of property, what is considered the fair market value. Again, all of these things are included within the guidance. We'll be including this information in our upcoming compliance journal, so you can kind of work through what those parameters might be. We'll be taking comments from the membership on this particular item. Comments are due to the IRS in January 20th. But the interesting thing about this particular guidance is when you're making the determination of what is rural and ag, for purposes of making sure that this loan is something that you can calculate the interest exclusion from, you're looking at what is the use of the property while the interest is being accrued. So it's a little bit different standard than what we're used to for looking at our state exemption, because we're looking at the state on the state side when the loan was made versus here on the federal side, what's going on with the property and how is the property being used as the interest is accruing on that particular loan. So a little bit different than the state component, but be sure to read the December compliance journal where we'll have a recap of what this interim guidance is to the best that we can outline it without providing accounting advice. We do have a second IRS item that I'll throw to Scott to cover regarding the car loans that we have, for which we have now a new reporting requirement of the interest that we've received from those car loans.
Yeah, thanks, Heather. And it has, as Heather mentioned, another tax item here. And even though we're not going to delve too deep into the accounting aspects, it is still important to be aware of. I know a few of you have already been looking at this and have reached out on it, and so we've discussed it. And so we just kind of wanted to share that information and what we do have and what we do know regarding banks reporting and other obligations with respect to this new tax credit and interest reporting obligation. So as a starting point, what we have here is a new tax deduction for individuals. And this is for interest paid on loans that are used to purchase a qualified vehicle that can then be deducted. And so that deduction applies from 2025 through 2028 with a maximum of $10,000 and a phase out for higher incomes. So there are certain requirements, and to qualify, the loan must be originated for a personal use vehicle and secured by a lien. Again, just giving you a high-level overview on it conceptually for those of you who may or may not be familiar with it. We know that banks then have had questions on reporting obligations, and to assist with that, IRS has since come out with some information, including a new form. However, as of time of recording this video, be aware that that's still a draft form and not final yet. So when you're reviewing that and considering it and contemplating its use, be aware that that is a draft form at this time. Of additional importance and awareness is that lenders must provide borrowers with a statement by January 31st of 2026, showing the total interest paid in the calendar year, that being 2025. That statement can be delivered online. It can be given through a monthly or annual statement as well, or similar means. So there's some flexibility on that. But be aware of this new tax item to keep on your radar. So with that, we will wrap up our tax items and move on to our agency releases, starting with FRB. And I'll hand it back off to Heather to handle that one.
Thanks, Scott. Several things from the Federal Reserve of interest to our compliance individuals. One being that they released an information statement that the intention of the Fed is to allow their examiners more deference to make sure in examinations that they really are looking at material financial risks of banks that they're examining and are not to focus on process and procedures as specifically as I have previously. So the good news is the Fed is following suit of the other agencies and giving their examiners deference to make the decisions necessary in the field to really look only at material financial risk and not to focus on the nitty-gritties. Another resource that we want to make sure you're aware of is the third edition of the Consumer Compliance Outlook. These are great resources. This particular one is focusing on Regulation E. They've gone through and updated some previously released resources on this particular topic and re-released it with just brushed up examples and some examiner findings, which make it more in tune with what we're seeing these days. But it does look at a recap on error resolution, on the consumer liability rules with some helpful examples, and then, of course, some examiner inside tips, which are helpful to compare against what you're seeing at each of your banks. We also wanted to make sure that you were aware of the recently released Supervision and Regulation report by the Fed. This comes out twice a year, and it highlights what they are seeing as a banking system condition overall, but more importantly to us compliance folks, regulatory developments, and some supervision developments that they wanted to make sure that their banks were aware of from an examination standpoint. So it's always good to take that information and compare it to what you're seeing from your own exam teams and what to expect to see their focus on going forward. Scott?
Moving on to OCC now. So first we have the SCRA, Service Member Civil Relief Act booklet. This is in the Comptroller's Handbook that's been revised. And so what's been revised here is the prior requirement to conduct an SCRA exam every 3 supervisory cycles. That has been eliminated. There's been some other clarifications that were made, but that's the major point to align with revised exam expectations. The OCC has also introduced minimum BSA and AML exam procedures for community banks. Similarly to what's been discussed, giving examiners more discretion, such as carrying forward prior exam conclusions and deciding when transaction testing is necessary, right? So this is something we've been hearing from the OCC, and the procedures, exam procedures and booklets are being updated accordingly. Then we also have OCC discontinuing annual AML risk data collection through the MLR system. And finally, assessment rates for 2026, those remain unchanged. And so overall, kind of what we have here to wrap it all together, these changes are collectively aimed to streamline oversight while still maintaining compliance and integrity, right? So OCC is still continuing to hone in on their risk-based approach with these changes. Heather, FDIC, I'll hand it off to you.
Thanks, Scott. Yeah, we have a couple of things we wanted to make sure were on your radar from FDIC. FDIC continues to tweak their Part 328 rule. This is the rule that sets forth requirements of how we are to advertise member FDIC and incorporate the new official digital sign. As many of you know, there's been a postponement in this area for the disclosures that go on to ATMs and other digital deposit taking channels. That mandatory compliance date had been postponed till March of 2026. And with the recent rule, which you can review in particular from the resources that accompany this video, the mandatory compliance date has been moved from March 1 of 26 to January 1st of 2027 with respect to those 2 sections of Part 328, that being point 4 and point 5, as relates to that narrow scope of the digital deposit taking channels. But still, for those of you who haven't implemented those parts yet, you do have a little bit more time to get those on your machines or in those places if you haven't already done so. And just a caveat that FDIC is still looking to see whether or not they want to further amend Part 328 as it relates to these electronical functions, just knowing that there's been some burdens in trying to implement what FDIC had previously wanted on this front. So a little bit more time there to work through some technical components. We also wanted to make sure that you were aware of the first of hopefully other rules that the agencies will be issuing on the regulatory threshold adjustments. For those of you who are at the recent WBA compliance forum, you heard of the agencies talking about looking at these thresholds to see if what can be freshened up from inflation standpoint and just overall review of indexing. And so here we have our first rule that happens to be from FDIC. It's effective here upcoming in January. And we've listed for you the various parts of FDIC rules, the 303, 335, et cetera, that are in the bullet point there. That is affected by this rule. But more importantly, section or part 363 is probably the one that Scott and I would most want you to pay attention to. That relates to whether or not you're having to pay for having an outside audit firm come and audit your financials. So there is some relief there for many of our financial institutions based upon some adjusted size of financial institutions, which is a good change as we roll into the next calendar year. So with that, we've got one more slide we wanted to make sure that was on your radar. So Scott, some interagency items?
Yeah, so lastly, let's cover what we have on the interagency side. So just a couple things here. First, the agencies are requesting input on ways to streamline call report forms and instructions. Comments on that are due on January 30th of next year, so 2026. And then also, they've proposed revising the community bank leverage ratio framework. So this is a big one and has been a point of advocacy for the industry in some past communications here. But the key changes being lowering the leverage ratio from 9 to 8%, extending the time that banks can remain in the framework without meeting all qualifying criteria, going from 2 years to 4. Subject though to a cap of 8 quarters with any 5-year period. And comments on that proposal are due after publication in the Federal Register. So this one is a little bit fresh, still waiting for that to be published, but it'll be 60 days, the comment period for that. But this again is going to be an important thing to consider for the industry, this being adjustments that could provide some meaningful flexibility for community banks that fall under the CBLR standards. So with that, that's everything that we have to cover there for this month. But I will hand it back off to Heather one last time to wrap us up, bring us home here.
Thanks, Scott. As we always do, we like to remind everybody of the resources that are available on the WBA website, from the compliance tools to the publications and trainings that are available to our members. Also, if you've got questions, don't be shy. Reach out to us, either an email or give us a phone call. We're happy to walk through your compliance questions and help with those additional regulatory questions that you might have. As Scott and I had mentioned here, there are several proposals for which comment from membership is always helpful, whether it be on the Section 1071 rule, the IRS guidance as we're calling the ACRE guidance, or on the community bank leverage ratio framework changes. We'd be happy to take those recommendations and your thoughts as we incorporate our comment letters back. But again, use the website materials and resources that you have, and we look forward to talking to you again next month. I hope everyone has a great holiday season. Take care.